Hello and welcome to Crypto Jargon, the series where I break down the complex terms that we use in the blockchain and crypto space. I'm your host OJ Jordan, and in today's episode I'll give you a simple definition of the terms support and resistance, Fib levels, head and shoulders, Elliot Waves, RSI, MACD and Wedge Pattern. These are all trading terms and acronyms, and this is why I bundled them together here in this episode. Starting with support and resistance, which are undoubtedly the most discussed forms of technical analysis. When analyzing chart patterns, these terms are used by traders to refer to price levels that tend to act as barriers, preventing the price of an asset from getting pushed above or below certain value. So, in simple terms, a support occurs where a downtrend is expected to pause due to a concentration of demand, which means that there are a lot of buyers willing to take action when the price reaches that level, thus preventing the asset's value from further decline, at least for a short period of time. Same goes for resistance, but in reverse. When the prices are going up, there comes a point where the market finds it hard to keep rising, and this is the resistance level. It is because there is less demand for that coin at that price, hence why we say that there is resistance from the buyers. Or it could also happen because there is a lot of sellers that are happy to close positions at this price level, creating more supply, which holds the prices from going any higher. What's interesting about support and resistance is that once a resistance gets broken and the price goes way above that level, it becomes the support for the future. So if prices retract, they're usually expected to stop and find support at that level. I won't go any deeper into how support and resistance works because this is not the purpose of this video. For a more detailed analysis, check out the links in the description box. Fib is the short for Fibonacci levels or Fibonacci retracement, which is a technical analysis system that is used to identify potential support, resistance and reversal levels. Fibonacci retracement is a mathematical sequence developed in the 13th century by the Italian mathematician Fibonacci. The sequence of numbers, starting with 0 and 1, is created by adding the previous two numbers. The Fibonacci sequence is significant because of the so-called golden ratio of 1.618 or its inverse, 0.618. In the Fibonacci sequence, any given number is approximately 1.618 times the preceding number, ignoring the first few numbers. Common Fibonacci numbers in financial markets are 0.236, 0.382, 0.618, 1.618, 2.618 and 4.236. These ratios or percentages can be found by dividing certain numbers in the sequence by other numbers, and this is how support and resistance can be identified during technical analysis. HNS stands for Head and Shoulders pattern, which is a chart formation that resembles a baseline with three peaks. The outside two are close in height, but the middle one is the highest. In technical analysis, a head and shoulders pattern predicts a trend reversal from bullish to bearish. In other words, prices are about to decline even further after the pattern has been formed. The head and shoulders pattern is believed to be one of the most reliable trend reversal patterns. It is one of several top patterns that signal, with varying degrees of accuracy, that an upward trend is nearing its end. It can also appear in reverse, known as reverse head and shoulders, and indicates that a bearish trend is broken and prices are going to keep rising, entering a bull trend. EWT stands for Elliot Waves theory, and it's another chart pattern that many traders use. It originates from Ralph Nelson Elliot, an accountant who published the wave principle in 1938. His theory of pattern recognition argues that market trends unfold in 5 waves when traveling in the direction of a primary impulse and 3 waves when opposing that impulse. In most simple terms, the price moves 5 waves in one direction as a trend and 3 waves in the opposite direction as a correction. This can be further divided into subwaves, and depending on the time frame, there can be many subwaves into any one of the larger waves. So I will stop here before it gets too complicated, but there are plenty of other videos that explain exactly how Elliot waves work. It's just not the purpose of this episode. Check out the description. Moving on to RSI. This stands for Relative Strength Index, a momentum indicator that measures the magnitude of recent price changes to evaluate overbought or oversold conditions in the price of a coin, or any asset really. The RSI is displayed as an oscillator, a line graph that moves between two extremes. It can have a reading from 0 to 100. And as an indicator, it was originally developed by J. Wells Wilder Jr., introduced in his 1978 book New Concepts in Technical Trading Systems. In very simple terms, an asset is considered overbought if the RSI is going to or above the 70 range, and oversold if the indicator is pointing to or below the 30 range. There is much more to it, of course, but I'm keeping this short and easy, so let's move on to the next one. MACDs. It's nothing to do with McDonald's, so stay with me. This is in fact a bit of a tongue twister. It stands for Moving Average Convergence Divergence, and it's a trend following momentum indicator that shows the relationship between two moving averages of an asset's price. The MACD is calculated by subtracting the 26-period exponential moving average from the 12-period exponential moving average. The result of that calculation is the MACD line. A 9-day exponential moving average, called the signal line, is then plotted on top of the MACD line, which can function as a trigger for buy and sell signals. Traders will buy an asset when the MACD crosses above its signal line and sell or short the asset when the MACD crosses below the signal line. In most simple terms, when the MACD falls below the signal line, it's a bearish signal, which indicates that it may be time to sell. Conversely, when the MACD rises above the signal line, the indicator gives a bullish signal, which suggests that the price of the asset is likely to experience upward momentum. And now on to the last term for this episode, the wedge pattern. It occurs in technical analysis when trend lines drawn above and below a price series go into an arrow shape. These patterns are thought by technical analysts to be useful in analyzing a short to intermediate term reversal from the current major price trend. There are three most common types of wedge patterns. Rising wedge, which is a wedge shape that is tilted upwards, that's the name, but it is in fact occurring during a downward trend or a bear market. It's a momentary upward shift, but the bear market continues afterwards. The next one is the falling wedge, which is tilted downward. It represents just the opposite of the rising wedge in that it denotes a brief downward movement during a bull market, but the bull market continues after the wedge has been formed. And there's the level wedge, which appears to move more or less in horizontal direction. Just like the rising and falling wedges, the level wedge shows a brief respite in a trend, but the trend continues once the wedge pattern is complete. Enjoying this content? Go check out Crypto Jargon, the ebook, out now on Kindle. It's an Amazon bestseller, and it's the most up-to-date crypto dictionary with more than 700 terms, acronyms, and trading slang related to cryptocurrencies and blockchain tech. Just go to ojjordan.com/cryptojargon and grab your digital copy today.